Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, April 11th, 2025. S&P 500 currently sitting at 5277. I'm David Zarling. I'm here with Ian McMillan. As always, plenty to cover this week. Some weeks more than others, but plenty to cover this week. Where you want to start?
Quite the interesting week, both directions. I don't know if we really changed much over the week, but we sure went a lot of different places. Basically where we were last Friday at the open. And yet, we had a 10% update, David.
Yeah.
So you're telling me we were up 10% in a single day, which, correct me if I'm wrong, you might have seen different stuff than it's only happened twice. Is that correct? October 2008 and during the COVID?
Yeah, moves like what we saw on Wednesday, ironically enough, are typically not what you see.
Yeah. And neither of those are at the bottom.
Right.
That was like mid-March COVID.
And that goes back to what we talked about last week for our listeners, is that the best days in the market typically are surrounded by the worst days and are hallmarks of downtrending markets. So we remain below a 200-day moving average. I mean, great day Wednesday.
Yes.
Not 10%. I mean, that's a return you typically see in a year, but hasn't really fixed anything at this point. Could we move higher from here? Absolutely.
Well, but we're down 20%, and then we were up 10, so I guess we made half of it back
yeah,
for a little bit, right?
Yeah, that's how the math works.
That's how that works.
Yeah. Yeah, if you have $100 and it drops 20% and you have 80 and it goes up 10%, well, you only got $8 back. So you're still down 12%. Math is hard.
It's tough.
Confuses people.
What did have a good week? Anything that's had a good week?
Yeah, I think we seen strength continue for gold. Gold miners now participating, which you kind of like to see those two work together.
Well, silver.
I know silver, not as much.
No. What's up with it?
I don't know.
I don't know either. But yeah, not. Gold's in a heck of an uptrend. I think we even hit new highs today or yesterday. But silver just continues to not do anything.
Right. You've highlighted it during some of our internal work, the strength out of aerospace and defense. Last week, we talked about strength out of home builders. That's since faded. And correlations are moving towards one. I mean, the average correlation of the S&P 500, according to Andrew Thrasher, is now 0.91. That's pretty high correlation. When all things start moving in the same direction, S&P is down about 14% from the highs, but you've got close to 60% of stocks inside the S&P are 20% off their highs.
Yeah, there's been a lot of damage done out there.
Mm-hmm.
If you had to be 100% long, anything you're buying this week or adding to?
Adding to, I think it would be gold. I think you could own Spain, maybe Argentina, maybe some aerospace and defense.
Thought that was interesting.
Yeah.
I'd say everything at this point, staples, utilities, insurance, that's kind of all took a thump on the head finally. Especially insurance. Insurance has been so strong. But as far as what's making new relative highs, yeah, the aerospace, which was strong before all this, right?
Mm-hmm.
Gold was strong before all this. Both of those have held up well. Sports betting and gaming.
Yep.
Those were relative leaders before the sell-off over the last month or so, whenever, 6 weeks, however long it's been going on. And even in the midst of this, those stocks and sub industries continue to find their way to new relative highs.
Right. Well, and it's interesting, right? You talk about relative performance, and there are things that are holding up. You talk about Argentina holding up well on a relative basis, but really until Argentina gets back above using ARGT above 81, do you really want to have any type of absolute exposure? And so you still have some broken charts out there. And when I say broken, I just mean sellers have control. Not mad about that. That's just the reality of markets. We're in price discovery mode. It's about finding when buyers are going to show up. And maybe we got that this week. Maybe this was the start of some type of sustainable low in broad markets. We'll see. But the fact that we haven't followed through on what happened on Wednesday, we're sitting below Wednesday prices. Technicians would call it inside days, right? So the price action that's happened since Wednesday has been inside the price action that happened on Wednesday. Not really conclusive.
Nope.
At this point.
Didn't lead to your point, nothing substantial yet coming out of that.
What do you think about China?
Oh, yeah, boy, they got as much volatility going on over there as we do. Definitely took a hit. I mean, had a pretty good start to the year on a relative basis. So the relative charts on most of these, I'm looking at FXI. If you look at a GXC, I mean, it's not terrible. Around the 200-day on an absolute basis. A lot of beta there, though.
Mm-hmm. When you look at things like broad semiconductors, so not a cap-weighted SMH, but something more like an XSD, and on a relative basis, still very broken. Semiconductors on a cap-weighted basis using SMH, trying to reclaim an important level that goes back, to early 2024. Haven't seen that yet. And really, when you think about cap-weighted, NVIDIA does need to hold $98 in order to hold that complete complex up. But while everyone's focused on equities, I mean, we're sitting at a negative rate of change on treasuries, long duration treasuries that we haven't seen since the late 90s.
Wow.
Using treasury futures. And with triple C credit spreads moving higher, junk bonds need to hold here. There's some signs of credit stress out there. And we're fans of highlighting that many times the credit markets know much more than the equity markets. And so you need to pay attention to these things. You need to pay attention to what are junk bonds versus, intermediate treasuries doing? What are triple C credit spreads doing? What are U.S. treasuries doing? Yes, they were green on Wednesday, but for the week, using something like TLT, down 7%.
And we've got 30-year treasury yields. I mean, back up a little bit off the highs today, but back where we were in January.
Mm-hmm.
I mean, we are too far from all-time highs on long-term treasury rates.
Well, and when you say all-time highs, you just mean like...
You're right. I should take that back. Clearly not all-time highs. Multi-year highs.
Yeah, decade, 15 years.
You're right. Thank you for correcting me. We're definitely nowhere close.
We're not close to the Volcker years of late 70s, early 80s, where, you're sitting up near 15, 16%. But to your point, yields haven't responded in the way that you would, quote unquote, think based on the equity environment.
No.
And the equity environment, this is one of those environments where you really have to be careful with your process. You stay disciplined to it. But with a VIX up in the 40s and 50s, a 2.5-3% move in the market either direction, perfectly normal. It's going to be the reality of the situation until we see volatility cool off. Can VIX go to 100? That's highly unlikely. It's very hard for a metric like that because it works more as an oscillator. But until we have volatility cool off, you're going to see these 2.5-3% moves in price either which way.
I agree. And I think that's what they can happen both ways. I think that's the important thing to take away from this. Wednesdays feel good, but
yeah, Wednesdays do feel good. And that goes back to, buy and hold. People like to say, if you're out of the market, then you're going to miss some of the best days in the market. Yeah, well, you're also going to miss some of the worst days.
Yep. Sorry, I missed Wednesday.
Yep.
Didn't make any money on Wednesday, to be honest.
Yep.
It was cool, though.
It was. But all the days that are surrounding it are what's been impacting negative returns for the market as a whole this year, especially for domestic. I should clarify that domestic equities and foreign equities weren't immune to selling last week. Some areas holding up better than others this week, but you do have a market environment where gold is rising, rates are rising. You now have a dollar trade weighted dollar using DXY near 100, which is the bottom of the range that's existed since 2023. And if that breaks, that will be interesting to see what dynamics change. We have oil. Oil did not respond like equities this week, trying to get back above 65. I think that's one to pay attention to. Is yes, it had a nice Wednesday, but again, not having technicians would call it follow through. We had Wednesday, and what you'd like to see is follow through to the upside to confirm that low, and we haven't seen it yet.
Are we squarely back in a weak dollar, weak U.S. stocks regime then?
Maybe.
It seems that way.
Right.
And that'll change at some point. Could be in a month, could be a few years. We'll go back to weak dollar, so good for stocks.
Yeah, I mean, the trade weighted dollar since the start of the year, since January, just a little bit after the start of the year, the trade weighted dollars are down around 10%.
Wow.
So we'll see. I mean, what are some levels you'd like to see buyers, enough demand in this market, reclaim to say, okay, maybe we do have a sustainable bottom on our hands? Is there any important levels using whatever metric you want?
I know last week we talked about the July 2024 highs, the 200-day. Now we're getting pretty far away from a lot of that stuff. Did hold the August 5th lows, which is a start. But see, now we're getting a 200-day that's rolling over. Man, that happened quick. That's what 2 weeks of this will do to your moving averages, though.
Right.
So that's now going to become a headwind. But if we go low, it'll always be, I guess, a signal. I do like we held the August 5th lows that we mentioned. I don't know. Like the 200-day feels, let me figure out the best way to say it. The 200-day feels far away to sit here and say, well, that's what I would wait for. That's too much cushion. But that's mentally where we're at. Right. Not mentally. That's our signal. So I don't feel a massive need to perfectly time the bottom. I'm glad to have that mental relief that, yeah, we could wait for the 200-day. And let's say we did get some type of V bottom-ish. I don't know. This doesn't really affect us. We're out, or we're back in where we got out. So it's all just a moot trade. So I think, yeah, for me, it's still the 200-day, the July 2024 highs, even these like September 2024 lows. What is that? September 6th, which we poked through on Wednesday. Haven't been able to keep that, though. So those would be mine.
Yeah, the volume weighted average price on using S&P. So our listeners would remember us talking about the breadth thrusts that happened back in late October, early November of 2023. Mm-hmm. And we had a good ride in trend that we fully participated in aggressively until February of this year. And the volume weighted average price from that low, that October 23 low, is still overhead at 54.13. And then the volume weighted average price from the all-time high back in late February is at 56.55. And those are both below the 200-day. So you still have to get through those levels to confirm that the broad market has strength. And this is all happening with a backdrop of pretty negative breadth.
Yeah, I would like to change my answer to I think the anchored VWAP from all-time highs is going to be a good. Well, and we got rejected, right? So you mentioned the one from the October 30th, 2023 lows.
Yep.
I mean, we got rejected there too. We closed above it, but in the grand scheme of this price, we didn't hold it. So I guess I'll call that kind of a rejection.
Yeah. So I think you need to clear 5,400 to give round numbers, 5,650 to prove that buyers have control of this market. And I fully realize that the financial media narrative out there is tariffs, all that. And that supposedly they've been paused. I get all that. But if tariffs are paused and we continue to correct for the next 6 to 18 months, well, there might be another narrative here, and we just don't know what that is yet. You can't wait for the narrative in order to make your decision. You have to use price for that, which is what makes technical analysis so powerful. I can't imagine making investment decisions without it. It's why we do for our clients. And so these important levels that we're talking about really they are markers on the highway, they're lines in the sand, however you want to demark it, that we have to clear to prove that buyers have control. And there's times when the market is innocent until proven guilty, in an uptrend. And right now we're in a market that's guilty until proven innocent. And this market's not innocent until we're above those levels, even just to start.
I mean, if you were a football coach and your quarterback came to you and said, "Coach, what can I do to prove to you that I can score, that I can get to the end zone?" So, well, first you got to get past midfield.
Yep.
Then we got to get to the 40 and then the 30 and then so forth. And it's the exact same thing with the chart. You're never going to get to an end zone if you don't get past the 30-yard line. It literally cannot happen.
Yep.
Same thing with price.
Exactly. Buyers have to prove that they have control of this market, and right now they don't. And I wish, because a lot of times investors are searching for information because they're trying to look for an edge, or, they don't know what's going on in the market. Well, the hard facts is no one knows what's going on. No one can tell you where price is going to be a week from now, month from now, 6 months from now. All you can be is a Bayesian statistician and take in the most recent information, wait a little bit more than you do the prior information. That current information needs to surpass the prior information that we just highlighted, 5,400, 5,650, the 200-day moving averages. Those would be your 40, 50, 30-yard lines on the way to scoring a touchdown. You can't get to new highs until you clear those.
And I wish I had an opinion.
Yeah, I wish I had a sexier answer to give you, but those are the facts.
So you weren't stressed out on Wednesday watching the market rip higher as you sat on the side of the road?
Nope.
On the shoulder?
Nope.
And I think there's a lot of freedom in that. There's a lot of freedom in that, Dave.
Well, and if this turns out to be a relief bounce, like a bounce and not a sustainable bottom, those are two different things. It's only a relief if you were positioned a certain way that was causing pain to begin with. If you weren't positioned in a way that causes pain, I suppose you could have FOMO, fear of missing out, but it's a little bit like watching someone drive past during a snowstorm on the highway at 70 miles an hour, thinking, man, I really wish I could be driving that fast. Well, that might carry some risk to it. And that's where we continue to be in a risk-off market. Don't need to participate at this time. There will be plenty of opportunity. I'm not saying that this downtrend continues forever, nor do I want that. But at this time, it's about preserving capital, and opportunity will present itself. There will be a time where there is no snowstorm, there is no sellers in control, and we can participate in the market again and take advantage of momentum. I can't tell you when that will be, but I know that I'm thankful for our current era where we can be in something like T-bills that gets, between 4.5%. There were eras where that was more like 1 or 2%. So at least we can get some return while sellers have control of equities until that time shows itself to get involved again. And we will. There will be a day. I just can't tell you when it will be. Anything else? What about like crypto?
Crypto is, it's held up. Well, there's been I think fair commentary. Now, some will say, well, Ian, we're down from 109 all the way to 74. That's a pretty big percentage drop. It's probably like 30%.
You're talking about Bitcoin?
Bitcoin, yeah. And so that's more than stocks have gone down. Yes, I get that. And this is hard to explain verbally. But in the context of price action, it's actually held up pretty well.
Right. Well, the way we could explain it is if you just take the price of Bitcoin divided by the price of S&P, it's held up really well.
And typically it is an asset that is the first to be thrown out of the portfolio due to its high beta risk on kind of attitude that it has. But yeah, it's really held up. Now we're still below 92. So that's definitely the big line in the sand. We got to get back up above 91, 92, that neckline. But I mean, we haven't even gone down to test the 21. What is that? It's like 64,000 ish
on Bitcoin. Yeah.
Yeah.
Yeah. Haven't gotten there yet. So holding up so far. And so you could say in some regard, it hasn't succumbed necessarily to correlations go to 1. So maybe there's more pain yet ahead for the market. Time will tell. And when you look across the entire crypto space, it for most of the last part of last year and beginning of this year, it was really the altcoins and crap coins that were really getting hit hard. And then Bitcoin followed, Ethereum's down. So it's not like it's not in a correction. You still have Bitcoin below a 200-day moving average. So it's definitely not out of the woods by any means, but it is interesting to note the relative strength there in the current environment.
What about your Fartcoin? How's Fartcoin doing, Dave?
Yeah, well, I guess Fartcoin had a really great week.
Great still earnings report. It's up 16% today.
Yeah, it's what a world we live in. That such a thing exists.
That's not me and Dave being silly. There's a crypto called Fartcoin. There's actually way worse crypto names out there that we can't talk about. Probably get in trouble with the FCC.
Yeah.
But you can peruse them if you choose. They are fascinating. Just another asset, no value, just supply and demand. Silly but pretty cool at the same time.
And I think it is notable that gold coins are better than Bitcoins. They're in an uptrend. Those two factions would probably argue with each other as far as store of value. And right now, gold is winning that argument. Whatever the backdrop dynamics are, fundamentally, price is showing us that there's more demand for gold than there is for Bitcoin.
They just sold. It's one of the last ones in our area, family-owned operation, store of value, and the guy just sold. Is a couple of blocks down.
Couple of blocks down.
And they're going to put up a gas station. No more store of value.
Yeah.
He was a good guy. His daughter ran it for the last couple of years. Took over the family business, but
can you imagine the trinkets in there?
They were cool.
Mm-hmm. So it's not a complete disaster everywhere. You've got, Bitcoin holding up, gold doing very well. Some areas internationally doing well. One thing that is really piquing my interest lately is the move in Japanese yen and what the Nikkei is doing. I mean, a Nikkei is a pretty major market. Even the DAX, which is highly correlated to U.S. markets, not exactly confidence building.
No.
On what's going on here. And isn't it interesting that the Nikkei price formation that took place, basically, let's call it from February of 24 through February of this year, March of this year, if that's all distribution, and the fact that it took place right at the 1989 highs, I mean, what a feather in the cap for technicians that behaviors matter, behaviors repeat. You get back to an area that had been a high before 35 years ago. I mean, that's pretty substantial. It'll be interesting to see.
Yeah, looking back on that, I mean, this is real. We had a failed breakout, much shorter term, back in July of last year. And that's on a daily chart. And now on a monthly chart, we have I'd put it in the same category, using your 1989 highs. We'll see where this ends up. Maybe we're building a range here. But yeah, I think it's fascinating to see kind of those things and you're like, I remember that happening last year, and you're like, okay, well, I guess we won't be buying Japan anytime soon. And here we are almost a year later, and kind of what it's evolved into.
Right.
What about dollar weighted Japan? How's that doing? I guess maybe even worse now with the dollar down.
Like EWJ, something like that.
Yeah, I don't know enough about a weaker dollar would make EWJ underperform, right?
Well, yeah, there's currency hedged, and then there's price in dollars.
So which ones? Well, let's put them together.
See, that's the beauty. That's the beauty of technical analysis, is you could say, okay, let's look at.
So EWJ is stronger with a weaker dollar.
Yep. Okay. Well, and that makes sense based on what you're seeing out of the yen versus dollar. I mean, the yen versus dollar has been strong since the start of the year. Until you see that pause or move lower again, you'll continue to see that type of relationship.
A lot of talk on the yen, and we're back to where we were on those August 5th, that kind of August 5th shakeout market low. Mm-hmm. So a big mental area there.
And if people listening to this are wondering why these guys spending so much time on the yen in Japan, it's just because of the strong relationship that you typically see between the yen and markets. Is that if you see a weak yen, it can tend to be a harbinger of like risk on. But when you see a strong yen, that's a flight to safety. And I do think it's a little bit notable that U.S. markets, made new highs in, what was that, February? Meanwhile, the yen was making a higher low. So you had a divergence there.
That's a good point.
And so do we have further correcting to do? Again, I don't know. All I know is that the information that we have at hand right now is it's a risk-off market. Sellers have control. And until that changes, don't need to be involved. Someday we'll be involved again. I'll be excited about that. Clients like it when we're
getting tired from all the twiddling.
Mm-hmm. Anything else, Ian, you want to cover?
There's not.
Well, then this would be a good time to highlight the supporter of this podcast, the Adaptive Select ETF listed on the NYSE under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Well, Ian, I appreciate you doing this again with me this week. To be determined whether we're doing anything next week. Good Friday, markets closed. We may or may not do a podcast. We want to wish everybody a wonderful Palm Sunday this upcoming Sunday. And then you go into Holy Week and you've got Easter the following week. So if we don't see you next week, don't worry. We'll be back in 2 weeks and you have a wonderful Easter. But otherwise, we appreciate you listening. Give us a high ranking on your platform of choice and share it with your friends. We appreciate it.
Have a great weekend, everyone.